Sure. Okay. So I guess we are about 70 odd people and more people will join us. But in the interest of time, I think we should start. So welcome everybody. Welcome to the fourth edition of our Commodity in Focus webinar series. My name is Hemant Bansal and I'll be your host for today's webinar. So a bit of introduction. I'm based in India, a principal specialist by profession and head of the commodities intelligence team at the SmartQ. I've been in this space for more than 11 years now, and my current responsibilities include, managing our clients across three core sectors, which is CPG, life sciences, and industrials, with respect to their commodity inflation management or volatility management needs. I'm also joined by my panelists, Nishita and Kumar. Nishita is an expert in energy and resin markets, while Kumar specializes in food market in the Smart Cube. They will be talking about their analysis of what they expect food energy prices to do this year and next year. But before they do that, let's quickly look at today's agenda. We will first start with an overview of current high inflation scenario across the globe that we are experiencing. We will also explore its key drivers. Then we are going to talk about a little why it is more important to track food and energy commodity prices among all the other commodity baskets. Then we are going to also look at what is stagflation and what causes it. We are also going to have a brief look back at the history of the last time we saw stagflation happening, and we will then analyze it together with the current data to discuss are we really moving towards it or not. Then Nishita and Kumar will be talking through what might happen to energy and food prices in case of stagflation, both from an upside and the downside risk perspective. And lastly, we are going to also talk about probable headwinds to watch out for in a stagflation type scenario and what are the strategies. So we will be discussing an aim framework that basically we can apply to our businesses to mitigate some of the impact. And of course, we will leave some time, towards the end for question and answer. So you will see there is a tiny little box at the bottom of your screen, which is Q&A. So throughout the webinar, whatever questions you might have, please keep on posting those questions in the Q&A box, and please, to the extent possible in a Q&A box, and avoid the chat box for posting the questions. Okay, so all right, let's start off at the beginning. The recent increase in inflation worldwide took many by surprise. You could see on your screen that as of early 2022, headline inflation was significantly above the central bank target in most advanced economies and several emerging markets. As you can see on the screen, inflation has been on a rise across all major economies. In the US, consumer prices surged 8.6% in May from a year earlier, raising inflation to a new four-decade high and giving American households no respite from rising costs. Inflation in the Eurozone hit a new record of 8.1% in May, up from 7.4% in April. This is partly, fueled by soaring energy and food prices and because of the Russian war in the Ukraine. And this is the highest level we have seen since the Eurozone began in 1997. Similarly, emerging markets like India and Brazil are also no different and have witnessed record high inflation in recent months. Though food and beverage and energy, typically accounts for less than one third of overall inflation in developed countries and 40% in developing countries. However, they can have significant impacts on the headline inflation, as their inflation tends to fluctuate significantly more than the other components. Therefore, it is important to know what is actually fueling the food and beverage and energy inflation. So now let's move on to the next slide and talk about it in a bit more detail. Now on your screen again, looking at the food and beverage and energy price index, statistically, we see more than 95% correlation between natural gas and crude oil prices with energy price index, and an equally high correlation of grains, vegetable oils with food and beverage price index. This is also making sense and also fundamentally consistent with the fact that crude oil and natural gas accounts for approximately 96% of the energy complex, while grains and vegetable oil typically accounts for 70% of the food and beverage pie. Therefore, we can conclude that an unprecedented jump in these commodities prices is the primary driver of inflation in energy and food markets. And it is really important to know what is the outlook or what is going to happen in these commodities for the rest of this year, as well as in 2023 in a stagflation type scenario. But before we take this up, with the help of Nishita and Kumar in the later half of the session, let's quickly look at why is inflation so high and what are the key drivers apart from the rising high food and energy prices for the current surge in inflation. So first up in your screen, like we discussed, is the high food and energy prices because of the Russia-Ukraine conflict. Because volatility in these commodities played a major role in inflationary pressure. So on February 24th, Russia basically invaded Ukraine, which resulted in a major supply shocks, leading to rise in energy and food prices, which inevitably meant higher inflation globally, because both Russia and Ukraine, as we know, are the major producers as well as exporters of commodities like corn, vegetable oils, sunflower oil specifically, wheat, etc. And the disruptions from the war and sanctions have caused global prices to soar. Secondly, the pandemic also resulted in the COVID-19 pandemic also resulted in a host of supply chain bottlenecks, right from outbreak-induced factory closures to restriction at ports. Similarly, congestion at shipping lanes to container shortfalls. This also hugely affected the availability of commodities and added to the inflation. Now, coming to demand, with easing lockdown restrictions, the recovery in industrial production, and accommodative government policies across major economies provided an additional tailwinds to demand. Further, multiple rounds of fiscal stimulus and expansionary monetary initiatives, led to high and persistent inflation. Roughly about $16.9 trillion in fiscal measures was actually announced globally to fight the pandemic. Lastly, labor market, played a very major role in this current surge in inflation. So the labor market disruptions, from the pandemic continued even after 2 years it began. Labor supply participations remained below pre-pandemic levels in several countries. Among advanced economies, the most, impacted was, or the impact has been relatively larger in the US, where participation is about 1.5% lower than before the pandemic. So labor supply shortfalls, particularly in intensive sectors, led to rapid growth in nominal wage and hence the inflation. So these are the key factors that contributed to inflation. Now, having talked about the inflation, I will pass on to my colleague Nishita, to further talk about stagflation and are we really moving towards it or not. So over to you, Nishita.
Thank you, Hemant. So the recent spike in inflation, and in particular the Russia-Ukraine war, has added to the fears that the world may witness an economic situation which has not been seen in decades. That is stagflation. Now the question is, what exactly does stagflation mean? Generally speaking, stagflation is a combination of words stagnation and inflation. It describes an economy which is experiencing rapid rise in consumer prices, slowing economic growth, sometimes even recession, and high unemployment. Now, this is a rare event because high inflation typically occurs during period of strong economic growth and low unemployment. Price levels are usually driven by economy's level of demand, and unemployment generally falls when demand increases. By contrast, stagflation offers the worst of both the worlds, that is, rapid price growth and widespread joblessness. Stagflation was last witnessed back in the 1970s. To understand this in detail and see whether we are really moving towards stagflation, let's take the example of the US economy. Now, As you can see on your screen, inflation in the US jumped to 11% in 1974, up from 3.3% in 1972. While inflation receded thereafter, it continued to remain well above the levels seen prior to 1973, before witnessing a spike again in 1978 and reaching a record high of 13.5% by 1980. Now, the reasons were a combination of external supply shocks and policy failures. In 1971, US President Richard Nixon announced a 90-day wage and price freeze. Further, in an attempt to boost American exports, he took the US dollar off the gold standard, thus devaluing the currency, which added to inflationary pressures. The Federal Reserve's attempt to fight stagflation using monetary policy only worsened it. Between 1971 and 1978, the Federal Reserve raised the interest rates to fight inflation and then lowered it to fight the recession. The conflicting measures confused the households and businesses and ultimately drove inflation higher. Next in line is the energy crisis that hit the US economy in 1973 when OPEC placed an oil embargo on the US and other nations that supported Israel in Yom Kippur War. The price of oil shot up to $13 per barrel, an increase of 400%. In 1979, another oil price shock driven by the Iranian Revolution disrupted oil markets and led to another 170% hike in oil prices, adding to the inflationary pressures. Now, looking at the current scenario, the US monthly inflation is at a 40-year high. As Hemant mentioned, the rebound in global demand following easing lockdown restrictions, along with shortages because of the supply chain disruptions, have contributed to this inflation. Furthermore, trend actually accelerated amid the surge in energy and food prices, especially after the Russia-Ukraine war. However, looking closely at the current estimates, we can see that while inflation during 2022 to 2024 will be higher than the normal levels, it is expected to remain well below the peaks seen during the 1970s. Now, this is so because the supply shocks due to the Russia-Ukraine war is likely to have a lower global impact than that of the oil shocks in the 1970s. Take, for example, OPEC controlled nearly 60% of the world oil supply in 1970s compared to Russia's 10% today. And hence, while the oil prices rose 400% following the embargo in 1973, it has risen only 60% since early 2022. Therefore, the magnitude of inflationary pressure is relatively lower than what was seen in the 70s. Moving to the next factor, that is GDP. Now, we can see that during 1971 to 73 and from 1976 to 78, US GDP growth was accelerating and it remained above 5% before the oil price shocks led to high inflation and curbed the growth. As a consequence of these oil shocks and monetary tightening, economic recession was witnessed during 1974 to 75 as well as 79 to 80. Now, comparing this with the latest data, we can see that the US economy witnessed a sharp recovery in 2021 following recession in 2020. However, according to recent estimates, there are growing expectations of a likely slowdown in the GDP growth during 2022 to 24 due to the negative effects of high inflation. The US Federal Reserve is also adopting an aggressive monetary policy stance. As of June 2022, it has announced a 75 basis point hike in the interest rates, which is the highest in 28 years in order to tame inflation, following a 25 basis point and a 50 basis point hike in March and May of 2022 respectively. However, the probability of a recession like the 1970s is low today because the policymakers are in a much better position to avert stagflationary headwinds. For example, the US Fed fund rates were in double digits during the first instance of stagflation and had reached a high of 20% in 1980. Currently, the Fed fund rate target stands at around 1.5 to 1.75%, which is way lower than the level seen during the 70s. Next is the unemployment rate, which increased to 8.5% in 1975, up from 4.9% in 1970. The slowing economy lowered the demand for goods and services, leading to job cuts. Unemployment gradually fell during 1976 to 79 as the economy recovered with rapid output growth, before increasing again during 1980 to 82. In contrast, job market is currently witnessing record low unemployment rate after sharp rise during the 2020 pandemic. Hence, we can see that while the economic conditions are presenting glimpses of what had happened in the 1970s, there do exist some stark differences. Yes, the similarities of oil supply disruptions plus rising rates, along with high inflation and slowing economic growth, are undeniable. But the world economy today is different from the 1970s. Monetary policy frameworks are more credible, with clear price stability mandates for central banks in advanced and many developing economies alike. Therefore, in our view, while the probability of stagflation has increased since last year, but the odds of replicating the 1970s style of stagflation remain low. Now, these trends don't only hold true for the US economy, but these can be seen for other regions as well. In the next slide, you can see that regions like India, Europe, Brazil are also experiencing high inflation along with the prospects of a slowing economy. Now, after understanding what stagflation is and what key factors are leading to the fears around it, let's see what is the outlook for the key commodities in the energy and the food basket. Now, starting with the most important one, that is crude oil. As we discussed earlier, the world witnessed an energy crisis in the late 1973 due to Arab oil embargo on the US, Canada, Western Europe, etc., which pushed up the crude oil prices from $1.6 per barrel in 1971 to $13 per barrel by 1974. Now, this was the first oil crisis and a key driver for stagflation in the 1970s. Once the embargo was lifted in mid-1974 and supply improved, the growth in prices came down by 1975. Currently, Brent crude oil prices have been on an uptrend for the past 1.5 years. Prices have increased nearly 60% since the beginning of 2022. A major blow to the oil market came in the February of this year when Russia attacked Ukraine. As we all know, Russia is a leading oil producer and its exports account for around 8% of the global oil supply. Now, this event sent jitters across the globe and pushed the Brent crude oil prices above the $100 barrel mark. Considering 2022 being a milder version of the stagflationary pressure, we at the Smart Cube expect crude oil prices to increase nearly 55% in 2022 as compared to 2021 average price levels. Assuming inflation to peak in 2022, crude oil prices may witness a 9% year-over-year drop in 2023, similar to a pattern observed in 1975, as slower demand and improvement in supply may push the prices down. However, there are some risks associated with this outlook. Starting with the upside risks, first and foremost is the expected decline in the Russian oil production. Following a supply decline of nearly 1 million barrels per day in April, Russian oil output loss could expand to nearly 3 million barrels per day in the second half of 2022. The EU, US, UK, Australia have already announced ban on Russian oil imports, and oil companies are shunning away Russian oil and products due to reputational risks and uncertainty around the future sanctions. The output loss may actually even increase if war continues and more countries agree to impose sanctions on Russia. Next in line is the lower than expected growth in the OPEC plus oil output. OPEC plus, which accounts for nearly 30% of the global oil supply, has been unwinding the historic production cuts it undertook during 2020 to manage the global supply glut. However, the pace of increase in production has been much lower. Countries like Nigeria, Angola, Iraq have failed to meet their output targets, and now with sanctions on Russian oil, the targets are more difficult to achieve. Further, OECD oil inventories in 2022 are forecast to decline close to 5% year over year and will remain nearly 7% below the pre-COVID levels seen in 2019. Coming to the downside risks, lockdowns in China, especially in financial hubs like Shanghai and Beijing, have added to the concerns of a potential slowdown in fuel demand. This is crucial because China is the largest oil importer and second largest oil consumer in the world. Next, fears of economic slowdown may also lower fuel demand. International Monetary Fund, that is IMF, has also lowered its global GDP projections to 3.6% in 2022 and 2023, down from 4.4% and 3.8% from its previous estimates. Plunge in economic activity lowers the demand for oil and products, which in turn results in drop in prices. Further, current elevated oil price levels may in turn also cause some kind of demand destruction, which may push the prices down. Lastly, projected rise in the US crude oil production in 2022 and 2023, along with strong US dollar amid the tightening monetary policy stance by the US Federal Reserve, may also provide a downside risk for the prices. Now, next within the energy basket is the natural gas. Unlike the crude oil prices, there were no major supply shocks directly impacting the natural gas in 1970. However, shortage of oil and petroleum products in the Western nations amid the 1973 embargo forced them to consider alternate energy sources. This pushed up the demand for natural gas and resulted in a 150% rise in prices in 1974. Natural gas prices in Europe have surged in 2021, reaching a record high levels by the end of the year, amid lower than average inventory levels, supply outages in Norway, lower supply from Russia due to its conflict with the Nord Stream 2 certification, and lower than expected demand during summers. In 2022, with Russia and Ukraine conflict, the European natural gas market has witnessed high volatility. In May 2022, prices were 150% higher compared to the same period last year. However, Europe's attempt to reduce dependence on Russian supply, improvement in inventories, as well as expectation of lower demand due to elevated prices may push prices down in 2023 after peak inflation subsides, replicating a pattern that was observed in 1975. Now, looking at the upside risks to the outlook. As the Russia-Ukraine war situation continues, supply risks are likely to remain, such as the damage to the pipelines and other infrastructures that are used to transport gas. Russia accounts for nearly 40% of Europe's natural gas supply. Further, Russia's demand for the unfriendly countries, including the EU member nations, to pay for Russian gas in rubles may also keep the market volatile. Russia has already halted nearly 15% of the total natural gas exports to Europe on account of these countries' refusal to pay for supplies in rubles. Further, retaliatory measures by Russia in the form of sanctions or gas supply cuts may intensify in the months ahead in response to EU's sanctions on Russian oil and coal. In fact, recently, Russia stepped up the use of energy as a blackmailing weapon by cutting natural gas shipment by nearly 60% via its Nord Stream 1 pipeline to Europe. On the other hand, downside risks would include higher LNG import volumes from countries like the US, Norway, Algeria, etc., which may support European gas supply. The European Union plans to decrease its dependence on the Russian gas by 2/3 in 2022 and has begun taking measures to diversify sources of energy generation in order to achieve the target. Improvement in gas inventory levels is also likely to help Europe cushion against supply shocks in the months ahead. Above normal temperatures in parts of Europe during the injection season in 2022 has supported strong inventory buildup. As of 31st May, inventories in the storage remain 47% full, in line with the 5-year average levels. Further, the European Commission recommended new rules on the minimum gas storage obligations, stating that the storage sites in the European Union have to be filled to 80% of capacity by 1st November this year, which will increase to 90% next year. Lastly, global natural gas consumption may drop due to demand destruction amid higher prices. European gas demand was about 9% lower during May compared with last year. High prices may lead to switch to coal in power generation and reduction in industrial consumption. Now, after having discussed the outlook for energy commodity basket, let's see how the grains and vegetable oil prices are expected to move during the second half of this year and 2023. For this, I would like to call upon my colleague Kumar. Kumar, over to you.
Thank you, Nishita, for sharing a detailed insight on the global energy market. Starting with grains first, that has affected the cost of everything from bread to cakes and noodles. In the early 70s, food prices surged due to scarcity in the global grain market, which was driven by a reduction in the output and low stocks. To give you a reference, global wheat stocks fell to 21% of annual consumption in 1973. In addition, the US embargo on soybean exports compounded the supply issue in the feed grains and vegetable oils market in 1974. Also, the food crisis coincided with a significant rise in energy prices, which affected food production and transportation costs. Now, if we look at the current scenario in the global grains market, we will find a similar trend unfolding now. Prices has surged in 2022, reaching a record high for wheat and are likely to remain elevated in the second half of 2022. If stagflation is inevitable, prices will most likely decrease in 2023, while the likelihood of constrained supply may limit the price drop. Now, coming to the factors driving price rally in global grain markets since 2021, prices were mostly driven by supply crunch due to a drought in the US and South America. The supply issue was further jolted in February 2022 by Russia's invasion of Ukraine, which resulted in the closure of ports in the Black Sea region, effectively halting grain export from the Black Sea. Russia and Ukraine is important for grains market because they collectively accounts for about 27% of global wheat export. Further, the supply chain disruption, which included exponential increase in freight and shipping charges, container shortages, and limited labor availability because of COVID-19 strains, also exerted upward pressure on prices. To give you a reference, wheat and corn prices in the US surged 48% and 30% between January and May 2022. Moving forward, while prices may inch down slightly in 2023, it is expected to remain elevated, driven by tight global supply and strong demand. Prospects of large wheat crop abandonment in the US, which is expected to be closer to about 25 to 30%, the highest since 2002, because of very poor crop conditions and persistent heat wave in France, may affect crop development, thereby positively impacting the prices. Cumulative supply of wheat and corn is forecast to drop about 3% year on year in 2023. There are, however, some risks associated with the price outlook. So starting with the upside risk, weather-related phenomenon, production disruption is important in important grain exporting countries, including the US, France, Germany, Russia, and Canada, might exacerbate the global supply crisis. Global wheat stocks are projected to drop about 4.5% year on year in 2023. Dry weather conditions in the US have delayed spring wheat sowing in the country and has also caused deterioration in France, the EU's largest producer and exporter of grain. Wheat crop condition in France has declined for the 7th straight week during the week ended June 13. Another factor that may lead to upside rally in prices is the possibility of reappearance of La Nina weather phenomenon in 2023. According to recent projections from the National Oceanic and Atmospheric Administration, La Nina conditions will likely persist through the end of the year, making the third consecutive La Nina winter season. The presence of La Nina brings more drought conditions in the US and might affect corn acreage in South America. The third factor that may pose upside price risk is the likely drop in wheat output in Australia and Argentina. Moving to downside risk to price forecast. Again, expectation of favorable weather conditions in Canada, Brazil, and Russia may drive up the country's wheat yields and exports, thereby causing a downward pressure on prices. For instance, Brazil's corn output and export are projected to surge 33% and 102% year on year in 2023. Another factor that can be a significant bearish for grains market is earlier than expected resumption of grain shipment from Ukraine through sea route. Though there are talks going on between Russia, Turkey, the European Commission, and the UN, the possibility of resumption, though still is not very high, but once resumed, this will certainly have a downside impact on prices. Now, moving to vegetable oils, as discussed in the previous slide, the US embargo on soybean export caused shortage of vegetable oils in 1973 and 74, leading to a significant inflation in global vegetable oils prices. Palm oil and soybean oil prices surged about 77% and 91% year on year, respectively, in 1974. Additionally, cumulative output of top 4 vegetable oils, including palm, soybean, sunflower, and rapeseed, fell 5.4% year on year in 1975. Similar to the global grains industry, the world vegetable oil market in 21-22 bears a resemblance to the 1970s. Prices of all vegetable oils reached new highs in the first half of 2022, and while they are likely to fall slightly in the second half, they will still remain high. In 2022, Russia-Ukraine war has compounded the supply crisis in the global vegetable oil market, causing a sharp upside rally in prices. palm oil and soybean oil prices increased 28% and 32% over January and May 2022. Now, the main factor driving this price rise was a successive year of production loss of sunflower in Ukraine, which is the world's largest producer of sunflower, and a slump in Canada's rapeseed supply, which is again the largest producer of rapeseed. This was further compounded by strong stocking demand from China and India, thereby causing a significant upside rally in Venezuela's prices. Now, a drop in sunflower oil that accounts for about close to 11% of total global Venezuela's production because of Russia-Ukraine conflict also added to the positive sentiment in the market. This is so because Russia and Ukraine collectively accounts for 76% of global SFO exports. The supply situation was compounded further by labor shortages in Malaysia because of COVID-19 related restrictions and non-seasonal rainfall during July and August, which was attributed to La Nina weather conditions in the Indonesia and Malaysia. So moving forward, in the event of stagflation, prices will most likely decline in 2023. However, and a projected recovery in supply of key veg oils further indicates of a downward movement in prices during the year. Global supply of veg oils are expected to rise by about 4.5% year-on-year in 2023. Now, there are some risks associated with the price outlook. So starting with the upside risk, the first and foremost is, as mentioned while we are talking about grains, is the possibility of reappearance of La Nina weather phenomena that can impact soybean acreage in South American nations. Another positive factor is extended dry weather conditions in Brazil and Argentina that may affect region soybean yields. Output in Brazil and Argentina are expected to drop about 9.7% and 6% year-on-year in 2022. The third factor that may pose upside risk is the likely reversal in policy by the Indonesian government and prospect of labor shortages in Malaysia. The Indonesian government has flip-flopped on the export policy multiple times in the first half of 2022, and a likelihood of such move remains open in 2023 as well. Any restrictive policy might cause supply shortage of palm oil in the global market, pushing up prices of veg oils basket. Moving to downside risk to price forecast. So first is larger than expected growth in global veg oils, including rapeseed, sunflower, soybean, and palm oil supply. So favorable weather conditions during the crop development stage and harvest period may lead to higher yield, as high prices had already prompted farmers to increase acreage during the current season. Another factor that may pose downside risk to price forecast is the likely drop in demand of veg oils from biofuels industry. So as expected, weakness in crude oil prices and high veg oils prices might prompt government to relax blending mandate that may weigh down on demand of veg oils. So earlier, when we saw that a rise in gasoline prices prompted US government to allow sale of higher blended gasoline during summers. So such moves can happen in future as well. And if such thing, any government decides to prioritize food usage over industrial usage of veg oils, that may certainly have a downside impact on its prices. Now, having discussed both energy and food market outlook, I'll now pass on to Hemant, who will take you through the risks and strategies to mitigate them. Hemant, over to you.
Thanks, Kumar, and thanks, Nishita, for giving us a detailed outlook on food and energy markets. So, folks, we have like 10 more minutes to go through, some of the probable headwinds and a framework that we have developed to mitigate, the stagflation type scenario. So, in this last section of the presentation, we will have a look at some of the probable headwinds which a stagflation type scenario could throw at us. And we'll also discuss the AIM framework on how to basically mitigate these headwinds. So moving to the headwinds first, so these are a couple of headwinds. The first up is, yes, given the ongoing conflict between, Ukraine and Russia, fresh COVID lockdowns in China, and other supply chain disruptions, and combining it now with the rising risk of stagflation. Now, the concerns about the slowdown in demand and hence global economy is definitely real. As also echoed by, the World Bank in its recent World Economic Outlook report, where it has slashed the global GDP, outlook. Therefore, the more consequential question actually that for us to prepare for is whether recession is coming or not. So whether the Fed will really allow higher prices for longer in order to protect growth, or will they keep on pursuing aggressive monetary tightening policy at the expense of the growth? So plenty of economists are expressing that probability of this occurrence of a recession is very low. Firstly, due to it has a very high political cost for several world leaders, to make, to allow it to happen, or, you know, and the secondly is because an already gradual slowdown in demand that we are seeing due to high inflationary pressure will also in somewhat or in some shape or form will basically make way for, less aggressive interest rate hikes in Fed by Fed in future. However, having said that, if recession is to happen, it can have a very high impact all around. So the next one is the labor disruption. If we move closer to stagflation, another headwind we could face is labor. In the wake of, high inflation, laborers will demand high wages to match the, the rising cost of living. Companies, on the other hand, would probably not be able to keep up with the steep increase in wages because of the mounting pressure on margins and, slowdown in business. Therefore, this could also most likely result in more labor force shortages, logistical delays in the future. The third is plant closures and logistic delays. Basically, business might have to deal with, more supply disruptions and longer conversion cycle, as there was a question as well, that we have received, how to tackle these longer convergence cycles as well. So business might definitely have to deal with more supply disruptions, due to double, I would say double whammy of slowdown in business and labor disruptions that we've discussed earlier. And last but not the least is, the important one is the more interest rate hikes by central banks. Now, we all know that yes, Fed has scheduled, or has ambitions to increase more interest rate in the future, and not only the US Fed, but all across the globe. ECB has recently raised, interest rate out of turn. Similarly, India, Brazil, etc. So one obvious impact that would have is it would be that consumer will have less purchasing power, which could again, lead to slowdown in demand. But on the other hand, it could also have an impact on your supply chain, as with more rates increase, suppliers, will experience a higher cost of capital. And this may have implications, as suppliers will probably try to pass it on the higher cost to you, basically in the form of price increases. Therefore, alternatively, if a supplier attempts to absorb these high costs, there is a risk of, supply disruption. So in both the ways, there is a supply disruption risk that we could, or you could see further, down the line. So to conclude these headwinds, it has been like the last 6 months, or I would say the last 2 years, are quite inflationary. The world has experienced a lot of inflation basically. And to summarize, inflation and stagflation are really the major issues that procurement needs to deal with, and are causing a host of challenges for procurement leaders. So these challenges are further now exacerbated by a host of internal and external factors, which is actually having an impact on procurement. So therefore, there is a need for proactive framework to deal with these challenges. And we at the Smart Cube, we call it as a AIM framework, which is Accelerated Inflation Mitigation, framework. So the framework has been actually divided into certain small sections or milestone, keeping in mind basis on the timing. You want to take a decision whether you want to immediately tackle a situation, whether you want to first tackle it and then strategize for medium term and then build resilience for the longer term duration. And also from these actions are from, on your screen is from a price perspective, from a supply side perspective, and a demand side perspective. So depending on where you're facing the headwinds, we can implement some of these uh, suggestions, or the suggestions which is is on your screen. For example, let's just take the first pillar, which is to tackle the immediate inflationary pressures from a price perspective, from a supply perspective, and demand perspective. So immediately what business can do, or the procurement managers or category leaders can do, is basically just run a spend analysis to identify the top spend areas for them and what are the cost drivers, develop the forecast, and then undertake the data-driven or fact-based negotiations with the suppliers. Another key thing that our clients are now tilting towards is, they're looking at their current contracts and see out of their contracts, what are the ones who are non-index contracts, and so basically non-index as in not linked to the market related indices or commodity indices or market fluctuations, and maximize spend on those contracts. So this is from a price perspective. From a supply side, again, before going in uh, with the negotiations, take an inventory check with only with your top suppliers and review existing contracts with them. Similarly, from the demand side, we could look at, evaluating the order size to get the right price, in that sense. So respond now is theme wherein we can immediately tackle, after implying all of these suggestions, we can immediately bring down or mitigate some of the inflationary pressure. Once we build the base, then the next theme is strategize next, meaning after initiating the action, now it's time to improve them, and you can improve them through, again, taking these actions, meaning, now it's a time for a medium term to review all your contracts, link it to the direct, the right commodity indices, check the formula inside it, whether your supply no is passing on the increase in inflationary pressure, but is your supplier is your contract or the formula is actually taking into account the discount factor in a deflationary kind of a scenario. So develop detailed should cost models, do a build, do a periodic discussions with your top and critical suppliers, also assess the risk to build a resilient, long-term future, and to build for to tackle these challenges in the future. Basically, the aim is to not do this exercise or actions only just one time or two time in a year. It has to be an ongoing mechanism to plan your budget, to plan your spending, and to keep on monitoring these challenges. One way could be, we at the Smart Cube is helping our clients is through inflation modeling. So it's basically what we are doing is we are doing a forecast of 250 odd commodities spending across their 2030 categories. We have mapped those commodities, right commodities to the right categories along with their internal spend data, contracts data. And then we are basically marrying the commodities forecast with the client's internal data to come up with a portfolio level planning and budgeting. So that is an ongoing process that we are doing with our couple of clients on a monthly basis, so that they have a view at the end of every month or quarter, and they can actually collaborate with their internal teams to see whether we need to course correct during the year or not. Another way could be, just be prepared, doing a scenario type modeling analysis. If recession has to happen, what impact could it have on my portfolio in 2023, 2024? So these kind of scenarios and plan Bs should be in place basically to tackle any future challenges. Similarly, from a supply side, diversifying the supply base is one of the key areas that we are kind of looking at. And also, not only the supply base, but do we have a choice to switch to an alternative raw material, which is less exposed to the market or less volatile. So these are some of the suggestions or enablers or action points you could basically put together in a framework, and can easily see where we stand right now and where we want to basically achieve. So I think that is it from our side from a content perspective. And now I think it's the right time to take up some questions that have come up on the Q&A box. So the first one is, how will organizations basically respond to lower demand and longer convergence cycles with rising inflation? So just to repeat the questions once again, how will organizations respond to lower demand and longer convergence cycles with rising inflation? So my take on this is, while demand is not in control of procurement altogether, in order to mitigate, the inflationary pressure and supply chain risk, we can work towards, build strong supplier relationship first and enter into long-term agreements. Hedging can also be a tool that can shield against the long-term uncertainty. And also it is very important to collaborate between the internal teams. Basically, it has to be, this question can not only be tackled by silos in team, but a procurement team or has to collaborate with their supply chain team, so that they both can plan and build a strategic inventory if required. So that's how basically we can tackle this question. I hope I'm able to answer it. The next one is commodity inflation triggering stagflation fears, or will stagflationary pressures impact commodity prices going forward? So it's a very interesting question. Nishita, would you like to take this up?
Sure, Hemant. So, definitely it's interesting, and I think everybody would like to understand this point. So, from our point, what we understand here is that these two actually, it's a two-way street actually. So, stagflation is often triggered firstly by some kind of supply shock. So, in the last 2 years, we have seen such supply shocks, be it the COVID pandemic and now with the Russia-Ukraine war. These two factors have actually resulted in the kind of spike we saw in the commodity prices, which have led to high inflation, which is now triggering the fears of stagflation worldwide. However, with the prices for the commodities, reaching multi-year highs, it also kind of results in a demand destruction for those commodities. And now, like after those price rise, we have now started hearing about slowing economy, slowing demand for such commodities, and that in turn basically starts to put downward pressure on the commodity prices, which is something that we have started to even observe be in oil market or to some extent even in metals. So yes, initially commodity prices have, because of the supply shock, triggered the stagflationary risks. But now with prices being high, that kind of results in lower demand, which in turn again impacts the commodity prices. I hope that answers the question.
Thanks, Nishita. The next question is, what was the inflation in China, Southeast Asia, Japan, and South Korea? So probably I'll take that one. So apologies, but we don't have the data for Southeast Asia, Japan, or South Korea right now. But China, as far as I remember, before the start of COVID, China was experiencing inflation somewhere around 5.4%. Then when COVID happened, it actually fell in the negative territory. And currently, during April, the Chinese inflation from a negative territory has reached to 2.1%, and it is kind of rising on a month-on-month basis in the last 2 months in the last 2 months, basically March and April. But just to answer again, because of the recent COVID outbreak in China, it can again go down. So the next question, again, I think it is for Nishita, for you. What are the key factors to watch out for in the oil and natural gas market to remain on top of the things? And if you have to prioritize them, what's the priority order?
So for oil and gas, I think the first major would be to keep a track of the developments that happen on the Russian front. Basically, Russia is important producer as well as key exporter for natural gas for Europe. So any new sanctions that happen on Russia or any retaliatory actions that Russia take, so that will definitely have an impact on oil and gas prices. Next would be China, keeping track of the lockdown restrictions that are currently happening in China, with China being one of the second largest economy worldwide and being a demand center. China's COVID restrictions again is, I would say, the second most important thing. And lastly, it would be to a large extent is the macroeconomic situations, keeping track of how the central banks are especially recently taking a tightening monetary policy stance, be it US Federal Reserve or the ECB, Bank of England. So that is again an important to keep track of for oil and gas markets, I would say.
Sure, thanks. Um, the next question is, what are the impacts of stagflation on commodities in specific country or regions such as China, US, etc.? So this question has been asked by Quan Yu. So to answer this question, basically, I think yes, different geographies will definitely respond to stagflation in different ways. Though one thing is eminent that slowdown or the stagflation type of scenario will definitely, drag down the economic growth in all the regions. Whether it's China, US, or Europe, but commodities can basically lag in terms of how they behave with respect to different regions. For example, China is currently facing an altogether a different issue. It is which is the recent COVID outbreak of COVID. So China is already low. Is basically their demand has been hammered a lot. So China, it will be a bit tricky because right now the demand is very low and hence prices are still, in China can be, can be at a lower level. But once China will reopen, because we know the China is the major market, can again drove up the prices. For example, right now metals are falling because of the stagflation risk. Fed is increasing the interest rate, dollar becoming strong, because of which metals demand is getting hammered and metals prices are coming down. But we also anticipate once the China reopens and it will start demanding, so then it has a potential to again keep up the commodities level very high. The next is Europe. So Europe is expected to feel more heat because Europe is, I would say, is more import reliant on with respect to their food and energy, needs specifically from Russia and Ukraine. So yes, though Europe has basically charted out a plan to phase out their dependency on Russia on oil and gas, but it would mean a long battle for Europe, to basically implement it. And so that will definitely keep inflation high in Europe, as well as at least high agriculture and energy prices in Europe. Similarly, for US, because US is relatively stable in terms of it's not that much import reliant, but because of the global impact that will happen on the natural gas globally or crude oil globally, it will also basically trigger down to the US market, keeping the agriculture and food prices at an elevated level, for sure. Okay, so I think these were the questions that we got. If someone have more questions, please feel free to post. Otherwise, I think uh, that is all from our side, from for today. Okay, so if there are no more questions, so thank you everyone. Thank you everyone once again for joining us and for giving us your precious time to basically attend this webinar, and have a great day ahead. Bye bye.